3M company, stock ticker MMM, is currently trading at $110. They have faced significant legal challenges and financial setbacks in 2023, but Wall Street is looking ahead as these events are now quantified. You can see over the last year they are down just over 9%. Ever since the October lows have actually been quite on a bit of a streak upwards up to 110, down from the lows from 85, 86. The stock has risen sharply, but is it overbought and is a pullback on the horizon or expected, potentially offering a better buying opportunity? That is what we're going to take a look at in this video. Because while 3M has struggled with growth and margins, it is currently trading at what appears to be a pretty cheap valuation. You can see the PE4 ratio sits around 12 over here, and it offers a pretty high dividend yield of 5.5% almost, and a dividend rate of $6. If we jump into the valuation grades, you can see on Seeking Alpha the PE non-GAAP 4 ratio sits at an A- grade. The PE4 ratio sits around 12, which is 25% below the 5-year average of 16, or what is roughly the S&P 500's average PE ratio. And as a side note, something I am looking to do in this new year is actually to get Seeking Alpha Premium to get more in-depth metrics and so on that can provide more value to you viewers out there. And if you take a look at the dividend stats, you can see here, as mentioned earlier, the dividend yield sits around 5.5%, annual payout of $6. Payout ratio sits at 65%, but again, this is a bit high compared to my normal taste, which is just a 60%. But I think this is probably okay right now due to all the litigation issues that has now been quantified, obviously. So I think going forward, as Wall Street likes to think, I think we are going to see a more steady dividend stock in 3M compared to a lot of the previous issues they have over the last couple of years. The 5-year growth rate sits at 2%, which is quite low. Obviously, they're not going out and hiking the dividend massively simply because they don't know how much money they are going to be able to pay forward. Due to all the litigation issues, again, they have now quantified them and there should be plenty of free cash flow to cover the dividend and also grow it in the future. But more about that later. And what obviously is something you really want to buy 3M for is the dividend growth streak, 65 years, just an insane stat alone. And if you take a look at the dividend history, you can see here back from the 1989 when Seeking Alpha started to record all these dividend days, you can see it rising ever so sharply ever since. And then back roughly 10 years ago, it actually went from around 64 cents up to 147. Quite a steep rise here, I must say, because we look now, you can see 144, 147, 148, 149, 150, and so on. And I most likely expect that the next dividend increase will be 151, obviously. And I don't think 3M will take any risks by hiking the dividend too much going forward. And as mentioned, 3M has struggled a little bit growth on the margins. You can see here the EPS estimates for December 2022 fiscal year is 911, year-on-year growth of minus 10%, roughly forward PE ratio of 12 as mentioned earlier, and it is expected to increase to 981 in the next year, so roughly an 8% growth from the current levels. And I think going forward that you will see some more growth year over year now that they have quantified all these litigation issues they have been facing. But let's jump into the financial statements to take a look at whether or not the dividend is safe going forward and if there's room to grow it. So first off, we want to check off, is the revenue growing? You can see at December 2018, 32 billion up to 34 billion. So that is a check. Coming down to net income, you can see if you want to disregard this one, obviously due to the legal issues, you can see they're taking a big write-off. But if you take a look at back from December 2018 to December 22, you can see it has gone up a little bit, not that much, but again, it is a slow growing giant. So I think this is a fair enough growth for 3M to consider going forward. And if we jump into the cash flow statements as well, you can see here how they are generating cash flow. So let's jump down here. You can see cash from operations sits at a pretty steady pace. Obviously, the capital expenditures are also pretty steady. So they are roughly generating like 6.6 minus 1%. So roughly 5 billion in free cash flow per year. So let's scroll down even further to take a look at how much money they are using on dividends. And you can see here common and preferred stock dividend paid 3.3 billion. So out of the 5 billion cash flow they have, 3.3 goes to the dividend. So obviously plenty of room to pay the dividend out. Sits around roughly the 60-65% payout ratio as we saw earlier. So all things considered, that looks pretty good, I want to say. Coming down here, free cash flow per share also growing. Back from $8.26 up to $8.77. So again, growing, but obviously in the meanwhile here, they have been a bit higher. But again, if we go up here again, you can also see that they've actually spent a lot of money on repurchase of common stock. So the share price have been beaten down that much. So they have actually repurchase some of their own shares. So again, that is also pushing up the EPS and pushing up the free cash flow per share. So this is in general something I really want to see them do. And obviously with that number of years of dividend payments, they do want to defend that dividend streak, and I think they have plenty of cash to do it. And with the roughly 2 billion in excess in terms of the free cash flow and the dividend paid out, I think there's plenty of money also to take care of the litigation issues. If they somehow structure a payment deal that is going over multiple years, then they can freely use the free cash flow and still keep the dividend and keep it growing as well. One last thing I want to do before we jump into the intrinsic value calculation is take a look at what Wall Street thinks about it. So you can see here, it's pretty much a hold. There's one on strong buy, one on buy, one on sell side, and then the remaining analysts, 16 out of the 19, are on hold. And what I've seen so far, I pretty much agree with them. But let's jump into our stock screener and take a look ourselves. So obviously what we have here is the key metrics that we ever so often look at. You can see here the EPS growth, yeah, pretty negative. The P/E ratio, as mentioned earlier. The revenue is growing slightly, 1.27%. Not too big of a deal, obviously, and we are relatively close to the 52-week high. So still some room to grow back to the 52-week high and a lot of room downwards towards the 52-week low. Net debt to EBITDA sits at 1.5, which is extremely good. They don't carry a lot of debt at all. I think it's very manageable. I think the margins are overall looking pretty good, to be honest, except the profit margin at negative right now. Obviously, I want to double check that. But again, the price to earnings is obviously negative here as well. So I think going forward that this should probably reestablish itself pretty okay. They have been under a bit of scrutiny above the margins, which hasn't grown over the last 10 years, but that I have mentioned earlier. The current yield, so on, we have gone through all that. I think the 5-year dividend growth rate is a bit meager, but still, I think they want to solve these litigation issues before going forward. The analyst target price sits at around the current level, so I think for the analysts, they are pretty much dead on right now. And if we go back just here to take a look what the price target is, yeah, the average sits around 112, so a mere 1.82% upside from the current levels. We do have some analysts thinking that the highs will be 157, and I think it's just because you can't really quantify the effects of what will happen now that the litigation issues will be solved or that's on the horizon. It can pretty much go either way, obviously. Jumping back into our stock screen, you can see here, return on invested capital, so return on equity are looking pretty good. I think it's very, very nice to see return on equity around 40%. Return on invested capital, I would just have it to be above 12-15%. So I think this looks extremely good. Let's jump into the dividend data tab and then zoom in a little bit to take a little bit better look. What we want to see here as often is pretty much just some steady growth. You can see here back from roughly the 10 years ago, as mentioned, the dividend growth was pretty massive actually. And now they've gone down to this 1 to 2%. So I think going forward, you should probably expect that these 2% and not these 9% that the 10-year dividend growth streak is, 10-year growth rate is actually. Coming down to the dividend yield theory graphs, you can see it's actually been in a undervalued territory for quite some time. Whenever we go above the line into the blue area, it could indicate a discount, at least according to the dividend yield theory. You can see here 26% at the current levels, at the current time. And ever since back 2018, it's actually been trading at a discount, at least according to the dividend yield theory. But to support that, we obviously have a lot of other valuation methods, such as the discounted cash flow model. Let's zoom out a little bit so you can see all my. I think maybe going forward, this is maybe a bit generous, but I think they can grow the free cash flow going forward now that they have started to quantify these litigation issues. They have started to rebuild themselves and repurpose themselves basically. So now they can look forward, which is also what Wall Street is doing. So I think 4% going forward is pretty okay for them. Obviously, we also have the dividend discount model, Graham's revised valuation model, the multiples valuation, the price to earnings valuation, free cash flow valuation, and also the Peter Lynch model. Feel free to skip back, pause the video at any time if you want to take a closer look at some of the estimates I have done. They are all something I have used, obviously, so you might have a little bit of a different opinion on some of them. And again, feel free to comment down in the comments if you have some issues with any of them, or if you just want to hear why I decided on a specific number. Before we go into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel for more videos in the future. Now let's jump into the summary where we do have all our valuation methods. The Grahams and the multiples were both negative, so I have excluded those two. The average intrinsic of all these valuation methods sums up to 119. With the current price being 110, it could indicate an average current discount of around 7% of the intrinsic value from the current price. Obviously, also want to apply a margin of safety. So to do that, we do have our margin of safety calculator over on the right, where we do take a stand of 25, and then depending on some of the key metrics such as EPS growth, return on invested capital, and so on, we arrive at a margin of safety of, in this case, 20%. So we will transfer that over here in the yellow box to the margin of safety. That gives us an acceptable buy price of $95. So if we're putting all this together, we have a stock in a pretty rough spot fundamentally, but with a valuation and yield that seems to account a little bit for the risk, to be honest. I think for me personally, I would wait for a bit of a pullback, as mentioned earlier, so we get closer to this acceptable buy price of 95. I do agree that the current price, according to the PE ratio and so on, at least according to the 5-year average and so on, I think that looks pretty okay. I think it's cheap enough if you look at it that way. And also I think if we jump into the dividend stats, you can see since 3M is a dividend king and they have grown the dividend for roughly 65 years in a row, I think they are dead on defending that part. So I think maybe this dividend yield theory is one of the correct ways actually to value 3M right now. So I think actually if you're looking for that 5.5% dividend income and you're not too bothered about the long-term outlook of growth, I think it'll be pretty okay to buy in. But if you do have a long-term outlook and are expecting some appreciation in the price as well for 3M, I think maybe this isn't the correct time. And for me personally, I'm more on the latter side. So for me personally, I would, if I wanted to own 3M, I would probably wait and see if I got a chance to buy it at a better price. For me personally, right now, it's a hold. Thank you so much for watching, and I'll be seeing you in the next video.